respondents again this year which are the following of a pre-selected list that they think were the biggest threat, the single biggest threat to the recovery of the property market. And here again we saw a big shift in sentiment compared to the situation a year ago. A year ago, concern was really dominated by fear, if you like, of a double-dip recession, of a relapse into a downturn. There's still concern about weak occupational demand, but two other factors have seen increased concern this year and moved into the sort of top spot, and that's shortage of debt finance and now interest rate rises and inflation. Panel, what do you make of that?
The big issues for us are, huge amounts of capital, moving around the system. I think there are, risks out there, but, the real estate markets are proving hugely attractive to new capital. But, we're seeing sovereign fund capital now, being very attracted towards real estate globally. And I think that's, quite an interesting trend. We saw, you talked about Asia earlier on being a target for capital. It's now a huge source of capital also. And Asian capital heading towards the European markets is becoming quite important with them, not just the Koreans, but the Malaysians, the Chinese, and becoming increasingly important.
The point coming back to the debt side of things, the debt market is going to overhang the overall recovery and the sort of increase in activity levels. Clearly there doesn't seem to be a shortage of equity. It's the other risk profiles that are where there is the great shortage at the moment, and the banks have really only just started to deal with a lot of the issues in terms of the volume that they've got to deal with. Partly because in the early part of the cycle they weren't able to address anything because of the shape of their balance sheets, that they actually pushed back quite a lot of maturity dates by 1 or 2 years in the prospect that the market would improve. So hence the reason why we're seeing this increased amount that comes through this year, next year, and until 2013. So that's really going to dominate and hang over the market. Clearly the equity level, the very prime stuff, there is no shortage, and there will continue to be activity in those levels. It's the next tier down where debt is going to be required, where there's be less liquidity.
I was just going to pick up on the occupier demand part, and specifically for retail. I mean, what is quite interesting now is that clearly we've been through some very difficult times, but when we're looking at specific assets now, at least we can work out where the winners are and where the losers. We can see what's happened to footfalls, we can see what's happened to turnovers, we can see what's happened to vacancy levels. And what is quite interesting is that investors are able to look at this period and actually choose the assets that have defended themselves very well. So it's actually really helped in some definition between what is good and what is not. And I think a lot of the risk as to where individual assets are going to go in the future is now understood and starting to be reflected fully in pricing.